What's up, my people? Welcome to another video of option science. I know I look tired and I sound tired too. Actually, indeed, it was a tiring day. The markets today was just terrible. It shot up in the morning, went like that, and then came down after taking a complete U-turn. And these are the days, guys. Traders like us find it difficult. I hate trading these kind of U-turn days. Anyway, that is part of different story. So today's idea for the video is to understand the basics of options. What is options and why do we trade options? So what I'm thinking is I'll take you all people through my journey, like how I started understanding things, and how I see options and how I understand the concepts of it, which has helped me in trading actually. So the purpose of putting it in a video form is that see, when I got started I had so many articles and millions of YouTube content to refer to and all that. So it is a time consuming process, but then I'll include all my learnings in a nutshell in this video so that those people who are getting started with options can find it easy. Okay, so I'll be scribbling down few things. So let's get into our screen recording and move forward in the video. Okay guys, so this will be the first part of the series of videos which I'm planning, where in which I'll try to explain you what are options, why do we trade it, and then on a few psychology points related to trading which will drastically change the point of view regarding trading, and then on thereafter a few strategies which I use, and then on trading with me. So a genuine disclaimer, I'm not a SEBI registered analyst, so whatever content which is included in this video is for educational purpose and quite personal to me. And before taking any trades in the actual live market, you should consult your financial advisor for the same. Okay, so let's get started. What are options? So before we get into what are options, let me just say why do we trade options. If you have a demat account with any of the stock market broker, you would have noticed that there are different segments to trade. First is equity cash, where we all land in for the first time, and then there are futures, then there is options, right? Please don't mind my handwriting, guys. My mom tried enough, I swear, but this is what best I could make it of. Okay, so equity is where we all land in for the first time, and then we proceed to futures without understanding what futures is, and then finally since it's very lucrative, we'll end up in options. All right, so let's just understand what is the difference. So here in equity, you buy shares, right? You buy shares of different companies which are listed in Indian Stock Exchange, and you buy at a low price and you try to sell at a high price. So the difference is your profit. So what do the companies do with this money? Investors pay money to buy the shares. This money is utilized for the functioning of company, and with respect to the performance which the company gives in, you get your dividend, or the profit of the shares goes up. Okay, value of the shares goes up. So that is about equity. Now the problem with equity is you can make money only in an uptrend, right? Cash market. So what do the companies do? They taking the money which comes in form as purchasing of shares, and they utilize this money for their functionals, and with respect to the results of the company, the share value goes up or goes down, depending on the performance of the company. So it is pretty much straightforward. There is no confusion whatsoever with equity shares. So the problem with equity share cash market is that you can make money only when market goes up, right? Because you are buying at a low price and you are trying to sell at a high price. So if the market comes down, you'll be in trouble. So what happens usually when market comes down? We wait for the market to come back to the same level at least to book it without any loss and get out of the market, or else we stay invested for long time, such that when eventually it comes up, we sell and make a profit, right? So equity shares can give you profit only when market goes up, right? Now let's come to futures. So in equity we buy shares. In futures, what actually happens is, let's try to understand it in a different way. Suppose there is a farmer. Okay, there is a farmer who is producing oranges, right? So a farmer who is producing oranges. Suppose on the first day of the month, let's say the orange price is 100 rupees. Okay, for let's assume for the sake of example that one orange is costing you 100 rupees. First day of the month, let's say May 1st. Okay. Oh, my handwriting is so terrible, isn't it? Okay, May 1st, one orange is 100 rupees. I hope you guys can follow. Okay, so on 1st of May, when farmers started cultivating, the price for one orange is 100 rupees. Let's assume that in the month end, that is on May 30th, I know there are 31 days, but that's not important, okay? The price of orange is actually going to be 80 rupees. One orange. Now, there can be multitude of factors which can affect the price of orange, right? So in this case, let's take an example wherein the price of orange falls after 1 month. This may be due to any surplus of oranges which are available in the market from different parts of the country, or even from outside the country. And since let's say if it is a season, by end of the month, the price of orange should drop because the season starts. So there will be surplus of oranges in the market. So when 1st of May, when farmers start cultivating, his price for one orange would be 100 rupees. But at 30th of May, the market price of orange would actually become 80 rupees. So here what the farmer does is, on 1st of May itself, he will ask the buyer to place a future contract for oranges with him, and he will argue that, see, today the market price as of today is 100 rupees, but I'll give you my oranges for 90 rupees. So the farmer says, you buy a future contract of oranges with me, wherein I will give you oranges at 90 rupees when the future contract expires. And usually the contract expires at the end of the month. So here, both the buyers as well as the farmers think that they are having an advantage. The buyer will think, okay, today the price is 100 rupees, but he is giving me a contract wherein which I can buy it back at 90 rupees. So what if the price goes up, right? If price goes up to 120 or 150, still I'll be in an advantage because I have a futures contract wherein I can buy it at 90 rupees in the month end, right? And farmer will think what? Farmer will be thinking that today is 100 rupees. Maybe due to season, it might even fall below 50 rupees. But since, I have given a future contract to this fellow, he will buy at 90 rupees from me at month end. So farmer will think that instead of selling at 50 or even below that, I can sell at 90. And buyer will think that, oh, instead of buying at maybe 110 or 120, I can buy at 90 rupees. Now, who wins the bet or who actually makes a profit out of it is the real game. So trading is a zero sum game, because whenever you win, somebody else is losing, right? So the decision to buy a futures contract should be based on different factors. I mean, the buyer should know what is the trend in the market, what is going to happen, and then make a call accordingly. And farmer also should know what is the trend in the market and the factors which are affecting the prices in order to make a profitable futures buy. A recent practical example is when Russia attacked Ukraine. US had imposed sanctions on import and export of Russian oils. and thus the global crude oil prices shot up like anything. So, had the crude oil buyers entered in a futures contract before the prices shot up, they would be able to buy the crude oil at the same prices even after the price was shooting up. So, different institutional buyers and sellers would enter into suitable futures contract based on their technical analysis of the factors which influence the prices, and based on their very well informed decisions. They enter into these contracts to prevent losses on either side, that is on the seller side and as well as on the buyer side. And one thing about futures is that once you enter into futures contract, you are liable to buy and sell at the futures agreed prices. You cannot change it. Once you enter a futures contract, you are supposed to execute the contract no matter what at the end of month or end of futures expiry, right? So that is about the futures. Now coming to options. So one thing which I forgot to mention in futures is that, so here actually in fact when the market price of a commodity, which is an orange in our example, went down to 80 rupees from 100, when the market went down, even then farmer made a profit of 10 rupees by entering into a futures contract, right? Actual market price of orange at the end of the month is 80 rupees, but then farmer sold the futures contract at 90 rupees, which enabled him to get a profit of 10 rupees, right? So even the market, when it went down, when the price went down, even then, since he had a futures agreement, since he had a futures contract, he made profit out of it. So in futures, we can make money in two scenarios: when market goes up and when market goes down. In both scenarios, we can make money. Okay, so earlier equity, we saw that we can make money only when market goes up. In futures, we understood that we can make money even when market goes up or goes down, right? So coming to options. Now options is little tricky. It is little complicated. In futures, we saw that whatever the price at the end of the month, those who own the future contract are supposed to buy and sell at the agreed prices only. There is no other possibility. They are supposed to execute it. So here, in the previous example, let's say the price of orange actually instead of going down, actually it shot up to 150 rupees. Okay, instead of going down to 80, it shot up to 150 rupees. Then in the previous example, buyer is the beneficiary, because since the market price is at 150 rupees, even though market price is at 150 rupees, the buyer is able to buy at 90 rupees due to the futures contract which he has signed with the farmer. And farmer is on the losing side, because instead of being able to sell at 150 rupees, since he had a futures contract with the buyer, he is liable to sell only at 90 rupees. So here the farmer tend to lose, right? Now options is one more step ahead, which we actually in technical terms we call it as a derivative of future, wherein future is a derivative of equity. So in options, instead of futures wherein at the end of expiry, or let's say in the example the end of a month, they are liable to sell and buy at same prices. They are liable to execute the futures contract no matter what. Okay, in options, instead of liability, they have optional choice whether to execute or not. Who? The buyer of options. Okay, the buyer of options has his choice whether to execute or not. Let us see how this works. Okay, let's say the buyer of option, or the buyer in general, in the previous example, let us take, buyer has given 5 rupees to the farmer and said that I need an option from you. You keep this 5 rupees. I need an option from you to buy back your oranges at let's say 120 rupees. Okay, 120 rupees. I need an option. and for giving this option I'm paying you 5 rupees. So what do the farmer do? Farmer takes in this 5 rupees and sells one option to the buyer to buy back his oranges at 120 rupees. Now the buyer is expecting that, okay, let's say the prices of petrol or something is going up, so the transportational cost will be too much. The oranges would be like maybe 150 rupees at the end of the month. But since I am buying an options from this farmer, I can profit. Let's see how he can profit. Now, since they have entered into this options contract, I already told buyer has the choice whether to execute the options or not. The seller who sold the option doesn't have a choice. He still has an obligation that he should enter into the options contract if chosen by the buyer. Okay, so let's say there are 3 scenarios. The prices of orange, let's take from the older example. Let's say first scenario wherein the prices shoot up to 150 rupees. Second scenario where prices drop into 90 rupees. And third scenario where prices doesn't change. It is at 100 rupees itself. All this at the month end or expiry. We call as expiry. Okay. So let's take first example. The price of orange actually has gone up to 150 rupees. Now here the buyer has the advantage. Buyer will say, okay, I have an option to buy the oranges at 120 rupees, which I bought from the farmer by spending 5 rupees. So I had spent 5 rupees only, but instead I am saving 150 minus 120, 30 rupees I am saving. Right? I spent 5 rupees on which I am saving 30 rupees. So let's say, let's enter into this contract and let's, complete the contract. So buyer will opt to complete the contract, enter into contract, and seller has no option. He has to obligate. So seller has to sell at 120 rupees to the buyer, and here the profit goes to buyer, and farmer, who is the seller, is on the losing side. Okay. Now scenario number 2, when the market price goes down. Okay. Now farmer has sold the option to the buyer to sell at 120 rupees. Okay, but the market price is only 90 rupees. So the buyer will not execute this contract. If he execute this contract, he has to buy at 120 rupees only. But since the market price is cheaper than the contract, he will buy from the market without executing the contract. So what he is losing? He is losing only 5 rupees, which is worthless compared to what he will be saving. Okay. So here 5 rupees is profit to farmer, because the buyer hasn't bought oranges from him at 120 rupees. All oranges are with him only, but he has got an additional free 5 rupees. Okay, which is due to the option which has expired, worthless. Now coming to third scenario where the price doesn't change. Okay, now the price is 100 rupees, but still the buyer will not execute this contract because buyer had the contract signed at 120 rupees, which says that he can buy the oranges from the farmer at 120 rupees. If market price is 100 rupees, logically speaking, he will not enter into this contract, or he will choose to forego that contract. Okay, so again, when the price doesn't change, again also 5 rupees is profit to farmer, because the option expired, worthless. 5 rupees is pocketed by farmer. Now out of three scenarios, two scenarios in two scenarios seller make money, right? And in one scenario buyer make money. But you see, whenever seller make money, it is just 5 rupees mere profit, but whenever buyer make money, it is huge profit, like in this case 30 rupees. The important point is, in options, you can make money if the market goes up as a buyer. You can make money if the market goes down as a seller. And again, you can make money if the market stays sideways, which means the price doesn't change, as a seller again. So in all scenarios, whatever happens to the market, whether it goes up, whether it comes down, whether there is a sideways movement, if there's a corona crash and prices come down, if there is a beaming bulls activity in the market and price goes up, and if nothing really happens and this price just stays sideways, in all market scenarios you can make money with options. You have to choose whether you have to be a buyer or a seller. Okay, now that is why we trade options. In all scenarios, all three scenarios, we can make money. In equity, only when market goes up. In futures, only when market goes up or goes down. But in options, whether it goes up, whether it goes down, whether it stays sideways, we can make money. So options are optionable. Okay, means you have the power, you have the authority as a buyer to determine whether to execute that options or not, hence the name options. And futures are obligatory, no matter what you have to execute in future. And equity shares, we all understand, right? So I know it can seem like very cumbersome, but then once you start seeing the beauty of it, it's very really easy to understand. Why I took the example of farmer and oranges, it's very practical to understand. Now in stock market terms, it will be really complicated. Things like put options, call option. As a matter of fact, in options, a buyer can make money when the market goes down also, and a seller can also make money when market goes up, and only a seller can make money when the market stays sideways, that is when the price doesn't change. Also, in the previous example, wherein the buyer pays 5 rupees to farmer to buy an option to get the oranges at 120 rupees, the 5 rupees paid to farmer, who is the seller, is called as the premium of the option, and the price at which he intends to buy it is called strike price. So in this case, we are discussing call option. The reverse case, where I said that the buyer makes money even when the market goes down, is called a put option. I'm not getting into the modalities of that because it will be too much for a beginner. So in our next video, basically we'll discuss what are the two different types of options, call option and put option, and what are the other parameters which define the prices of an option, like theta, gamma, vega, etc. These are called option Greeks. So trading in options is a bit complicated, but once you understand the concepts very well enough, and if you're clear about the different aspects and the different parameters which are in the play when an option contract is running, you can very well come out with profits. So to summarize, guys, let's keep it simple. In this video, we learned what is an equity shares, what is a futures contract, what is an options contract, and how do the futures and options contract differ to each other. Also, we learned what is a strike price, what is the option premium which is being said to have paid by the buyer, and also we understood there are two different kinds of options, the details for which and the parameters which affect the options prices I'll be coming up with a next video. Okay, so to summarize, that's it. I know the screen, everything looks messy. I'll try to improve the the display. So I hope you guys are clear on the concept why we trade options. Basically, we trade options because in any market scenario, whether the market crashes, the price goes down, whether the market is on a bull run, the price goes up, or whether the market stays range bound, that is the price doesn't change much over a period of the time, and it stays almost the same without moving much, then also we can make money. So in any market circumstances, we can make money if you know the right techniques with options. So that is why we sell options or we buy options. Basically, that is why we trade in options. And I hope you would be having some idea, if not entire, some idea about options. So tomorrow, if somebody asks you, options and futures, you will be able to distinguish a bit and have an idea, I believe. So that's it for the day. Any doubt you can put on as a comment here, and I'll be coming up with more videos, like I said, about options, the different types of options, call option and put option, and the different parameters which govern the prices of the option, which are option Greeks. And after that, the basics will be covered. Then we'll move on to little psychology aspects of the trading, and thereafter we can discuss strategies and ideate ourselves. So guys, once again the disclaimer, all views expressed are just personal to me. Do not take any trades or do not trade in these financial instruments without understanding the risk involved in it, and also seek advice from your financial consultant without making any final decisions on actual trades. That's it, guys. Thanks again once more for listening. I'll see you in the next video.